Hey everybody, welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick. Securities offered by MoneyBlock. Well, we're going to take a look at a key strategy that I think you can start to implement in your portfolio, especially in the near term. Now, for those of you that aren't option traders, this is going to be very simple, very straightforward, and it's going to be something that you could, at the bare minimum, learn how you can add some strategies with a very fixed amount of risk. In other words, a small amount of capital, but it could actually pay some decent dividends. And what I'm talking about is we're going to add some exposure to bond markets. Now, the bond markets have been quite volatile over the last couple of months. And right now what you're looking at is a chart on the 10-year U.S. government bond yield. You see that it's gone from 260 back in, about March of this year right around there. And pull this up a little bit. So you got it March right here, and you have it coming all the way down to its lows of 215 that we saw in the beginning or mid of April. Now we're coming at the tail end. Bond yields have been moving up. That means bond prices are coming down. That means that risk-averse trade where people were getting a little bit fearful, that's starting to come off. Bond yields are at 232 on the 10-year, and they're at 298 on the 30-year. Now, most of you are not going to be trading the 10-year and the 30-year bonds, bond futures, bond options, but you could use a product called TLT, which is a combination of the 10-year and 30-year bond, and it just tracks the price. So when bond yields go up, so you hear me say, oh, the 10-year bond yield goes up, the 30-year bond yield goes up, you're thinking, well, then TLT is probably going down, right? Because this is inversely correlated to bond yields. If bond yields go up, TLT's price goes down. But we're at a critical level right now in the TLT life cycle. It was trading above its 20 and 50-day moving average. Now, this is just support and resistance as far as I'm concerned. When you're looking at this, it gives you context of the trade over the last 20 and 50 days. And right now it's in a battle. Anybody that's bullish on bonds, in other words, thinks that the prices of bonds are going to go up, it needs to hold both the 20 and the 50-day moving average, both in the short term and the intermediate term. Looking at the action right now, it looks like it's going to settle below its 20-day moving average, which then has the short-term bulls on their heels, looking to challenge its 50-day moving average at 121.62, which is coming up very quickly on a daily chart. This is where the intermediate term bulls would be under pressure. Now, we haven't seen that kind of pressure in the last couple of weeks. As a matter of fact, we haven't seen it in the last month. The whole month of April, you've seen that bonds have been trading in an uptrend until today, or at least the last 2 to 3 sessions. Obviously, we've had some relief news come out of France, but remember, they still have a final vote on May 7th. Marine Le Pen still has a chance of winning, even though she's behind in the polls. Remember the U.S. results. The second thing is that the president is running into resistance on his tax reform bill. He wants to get corporate tax reforms done, but remember, he just launched a tariff on Canadian lumber. He doesn't need congressional approval on that tariff. That tariff is done. That's going to now put a 20% tariff, I think it's 20 or 25% tariff on all incoming lumber. That's going to impact names like Pulte, Toll Brothers, home builders, which had great numbers coming out this morning, but that's going to impact that supply chain, and it's going to potentially flow into a Lowe's, a Home Depot, eventually, right? I'm not saying that it's going to, or it has to logically have to happen in unison with how it flows through ultimately to the consumer. But all I'm saying is that there's enough information out there, enough binary events on top of earnings, economic data, and geopolitical components that, you know what, maybe the safety trade is something that you might want to add, but you don't want to add it just unabandoned. In other words, just go buy bonds because it's just looking like it's too risky to just buy them outright. So how do you actually do it? We're going to use a strategy that we've talked about before in Strategy Now called a bull call spread. And basically what I want to do is just go to my options trade ticket, and I just want to set up a very simple bull call spread, which basically means when I say bull and call, it just means that I want to take advantage of an upward trending market that may be under some pressure, but I believe in the next 20 to 30 days that the underlying could be moving to the upside. There could be some sort of catalyst, but I want to do it with fixed risk. In other words, I don't want to have an enormous amount of capital risk. Use a call spread. A call spread allows you to participate in that upside move to a specific level. It also has a specific risk. So let's jump down to the chains. I'm going to display the Greeks. Now, as I said, I want to have about 45 days until expiration. So that means I'm going to be looking at the June 2nd, somewhere between 35 and 45 days on these debit strategies. In this particular case, what I'm going to do is I'm going to look at buying an in-the-money call. What is an in-the-money call? Well, with the underlying trading at 120.170, that's where the TLT ETF is trading. That's what tracks the combination of both the 10-year and 30-year bonds. It's trading at 121.70. So I want to buy an in-the-money option. And this option here, the 120 calls that it's expiring in 38 days, is trading for $2.86. That means my maximum risk to buy these calls, which gives me the right to own TLT at 120, is $2.86. Now that's $286 per contract. That's your max risk, folks. If it goes down below 120, that's all you can lose. Now, since I'm a prudent trader, I want to also improve my odds of potentially having a profit. I'm going to reduce that debit, or in other words, the cost that I'm buying these for, by selling another option against it. Now, I'm going to sell the 123 calls, okay, and I'm going to collect somewhere around $1. So that's going to reduce my purchase price by that amount. So I no longer have $2.86 worth of risk. I have $1.86 of risk if I trade this on the bid-ask spread. That also is an area where I give up something. The maximum profit point that I have is up to 123 between now and June 2nd of 2017. So over the next 38 days. If you do not believe that the underlying could go up, in this case, above 121.86, and it's currently trading at 121.70, then don't make this trade. But if you do believe that it could challenge 123, which, if you look at the chart, I do believe that it has the potential. If there is any negative news over the next 38 days, whether we don't get tax reform, whether in the next 4 days the government could potentially be under the threat of a shutdown, which wouldn't be necessarily good for either the bond market or the stock market, or a Le Pen victory, or some other geopolitical issue in, like, for instance, North Korea, which we are not talking about as much, even though they were lobbing some more missile tests today. The bottom line is that this gives me an opportunity to participate in the bonds if the bond prices increase, or in other words, yields drop. Also, what happens if yields start to pull off without any other catalyst, right? Let's say we have lukewarm economic data for the remainder of this week. What happens if earnings start to come out mixed? Bonds might start getting bid up, which means yields come down. If you see the 10-year yield go below 230, or if you see the 30-year yield go below or challenge 290 on the yield, that could be a very bullish thing for bond prices going up. So if you buy one contract, you're basically, the bid ask is a little bit wide at 137 and 158. I would probably put in a limit debit of somewhere around 1.45. So that means $145 per contract. If I'm risking $145, that means I could potentially make $155 if at expiration the underlying TLT is at 123. What are the probabilities of profit? Roughly around 52%. So it's a little bit better than a flip of a coin. What's the probability of making 50% profit? About 69 to 70%. So in other words, the probability of making about 70 cents on this is around 69% between now and April expiration. So you could put an order out there at $2 or $2.10 for taking a potential profit at 50%. I would actually probably shoot for a 50% profit target, so I'd be somewhere between $1.90 and $2. The extrinsic value that's in this particular trade, in other words, the amount that it's out of the money, is a little less than, it's right around 30 cents right now. So that would be where your break even would be. If I buy it at $1.45, it's actually a little bit less than that. As a matter of fact, if I buy this at $1.45, I'm actually in the money by 35 cents. So in other words, even if the TLT pulls back 30 cents and stays there between now and the next 38 days, I'm break even. But my max risk is the $145 that I'm willing to pay for this. I review the order. You can clearly see that what I'm buying and what I'm selling. And let me see what this is. And that would be your total risk. And then you basically manage your trade by going in after you're filled, going in and managing your positions. It's that easy, folks. And so, again, if you're looking to participate in a downward trending market that still has a bullish, somewhat slightly bullish sentiment, even though it's under pressure, then you could use the bull call spread. And specifically, we looked at it in terms of using it in the ETF that tracks the bond prices, TLT. All right, that's it right now for Strategy Now. If you ever have any questions, you can always email MarketStream.live at info@MarketStream.live, or you can email me directly at jcusick, JCUSICK, @moneyblock.com. All right, join me at 3:30 Eastern Time, 2:30 Central. I am going to be going over Tech Talk. I'm going to talk about a couple stocks that have earnings. We're going to take a look at what their estimated moves are going into this hot earnings cycle. See you at 2:30 Eastern Time, 3:30 Central here on MarketStream.live.